Let's get right into it. Today, we are breaking down one of the most fundamental, but also one of the most powerful tools in any trader's toolkit. I'm talking about the moving average. Think of it as your simple compass for navigating what can feel like a super noisy market. And I just love this quote because it's so true. This is a tool used by literally everyone, from brand new retail traders just clicking their first buttons, all the way up to some of the most sophisticated systematic hedge funds in the world. Its power really is in its simplicity. At the end of the day, a moving average helps you answer one crucial question, and it helps you answer it fast. Is the price movement I'm looking at right now a real directional trend I can actually follow, or is it just the random, chaotic noise of the market?
And this is maybe the most important thing to get about the goal here. We're not trying to predict the future, okay? A moving average is not a crystal ball. Its job is to be a noise filter, to smooth out all that chaos and to act as a compass, just showing us the market's general direction. That's exactly why you always hear long-term investors talking about the 200-day moving average to define whether we're in a big bull or a big bear market.
So, with that foundation laid, let's get into the nitty-gritty. What exactly is a moving average, and how does it actually work on a chart?
Well, it's pretty much what it sounds like. You take the closing price of, say, the last 20 candles, you average them out, and boom, you plot a single point. Then, when a new candle forms, the oldest one drops off, and the average gets recalculated. That's why it moves right along with the price, creating that smooth, continuous line you see.
And this is a brilliant way to picture it. Think of the raw price chart. It's like someone frantically running up a set of stairs, right? Lots of little ups and downs, very jerky movements. The moving average, well, that's the escalator. It just ignores all those frantic little steps and shows you the smooth underlying direction of travel. Now, there are two main flavors you're going to run into. First, the simple moving average, or SMA. It treats every single price in its calculation equally, so it's a bit slower, a bit smoother. Then you've got the exponential moving average, the EMA. This one gives more weight, more importance to the most recent prices, which makes it faster and way more responsive to what's happening right now.
You're also going to hear a lot about something called crossovers. This is just when a faster moving average, maybe like a 50 period, crosses above or below a slower one, like the 200. And these things have some pretty famous names: a bullish golden cross and a bearish death cross. And they often signal a potential major shift in the trend.
Okay, this is probably the most important part. We've got the theory down, but how do we actually apply it? Which moving average should you be using, and when? Let's build a quick framework for that. It's really just a simple three-step process. First, you have to know who you are. Are you a long-term investor holding for months or years? A swing trader holding for a few days or weeks? Or an intraday trader, in and out within hours? Second, you got to decide, do you need speed or smoothness, fast or slow? And third, you pick a number, a period, that actually matches your trading horizon. And here are some classic starting points, some go-to settings. Investors looking at the really big picture, they often use a 200-day simple moving average. Swing traders might use a 50 for the medium-term trend, and then maybe a 20 to time their entries on pullbacks. And day traders who need that raw speed will often use really fast exponential moving averages, like the 9 and the 21. So here's the number one rule, and if you take nothing else away from this, please remember this slide. Your tools have to match the job. A long-term investor trying to use a day trader's moving average is going to get absolutely chopped to pieces with false signals. It just doesn't work. Now, because moving averages are so simple, it is incredibly easy to misuse them. So let's talk about the common traps that catch so many traders, and more importantly, the easy fixes to keep you out of trouble. First up is the classic one-size-fits-all mistake. You learn about the 50-period moving average, and suddenly you're slapping it on a 5-minute chart of crude oil and a weekly chart of Apple stock. That is a recipe for disaster. And the fix is exactly what we just covered. You have to be intentional. If you're an intraday trader, you should be using fast EMAs. If you are a long-term investor, you should be using slow SMAs on high time frames. You have to match the tool to your specific style and your time frame. The next big trop is seeing every single crossover as a signal to buy or sell. When the market has no clear direction and is just chopping sideways, these crossovers are going to happen constantly, and they'll whip you in and out of trades for loss after loss after loss. It's brutal. So the fix here is to add what's called a regime filter. Before you even look for a signal, you have to ask yourself, what is the market regime? Is it trending? And a super simple filter is to just look at the slope of the moving average itself. If it's not pointing clearly up or clearly down, just stay out. Now, this might be the most dangerous trap of all, treating the moving average like it's a complete trading system. It is not. It's just one piece of a much bigger puzzle. Without a plan for where you get in, where you get out if you're wrong, and how much you're going to risk, you're just gambling. So, the professional approach is to use the moving average as a guide, but within a larger context. You combine it with an understanding of market structure. Are we making higher highs and higher lows? Use it to confirm the trend, not as the sole reason to jump into a trade. And always know your exit plan before you ever click that button.
So there you have it. You have the compass, you understand what it is, you know how to choose the right one for you, and you know how to avoid the most common pitfalls. The real question now is, are you ready to start building an actual strategy with it? In the next explainer, I'm going to show you 3 complete moving average strategies from start to finish. We're talking a trend pullback setup, a crossover strategy that has a chop filter built in, and a really useful long-term trend filter strategy. And hey, do me a favor, let me know in the comments what market and time frame you trade, stocks, crypto, forex, whatever, and I'll tailor the examples directly for you. I'll see you in the comments.